Thank you, Ryan. I am going to share my screen. Good afternoon, everybody, and let's see if that works. Thank you for having Cooley today. As Ryan said, I'm a partner in the San Diego office, and I specialize in equity financings, both private and public company securities offerings for the most part. And as Ryan said, my friend and colleague, Rebecca Jones, is going to co-present with me today. Rebecca's a Cooley alum, and I actually see some other Cooley alums on the call. So welcome, especially to the former Cooleys. It's a little bit about Cooley to start, for those of you who don't know, and I hope a lot of you are clients already, but for those of you who don't know, Cooley is particularly active in the venture capital space, both on the investor side, the fund formation side, and on the company financing side, which is the side that I primarily sit on. A little bit more information about our venture financing work, and this is intended to give, I guess, me a little bit of credibility, but also Cooley. And again, I'm going to talk today from the perspective of somebody who does a lot of early stage venture financing work on the behalf of the companies primarily. And then this is who Cooley is. We're sort of everything. If you don't know, we're an international firm now with locations in 11 different geographies, and we sort of do everything corporate wise. Today, we're going to talk about strategic financings. And when I say strategic financings, what I'm talking about is perhaps your company, you're in-house at a company, and your company is going to make an investment in a private company. And we will talk about Series A and Seed sort of interchangeably today. And the intention is to talk about sort of if your company was investing in the first financing of a private company. We'll talk first about valuation, then we'll talk about some other key points of negotiation, and then we'll talk about some features or terms that are specific for you as a strategic investor that may be different than what a venture fund would be seeking in a financing like this. So valuation is sort of the core negotiation point around which preferred stock financings are done. Valuation determines what price the investor pays for the stock, and ultimately, or relatedly, sort of how much of the company the investor owns for their investment. And I have found, I talk a lot to founders and companies and investors, and I have found that for folks who are sort of not dealing in this day and day like I do, valuation is a little bit of a tricky concept. So we're going to spend just a little bit of time today talking about it. And you will hear the terms pre-money and post-money. So pre-money is short for pre-money valuation, and it is what the company is valued at before the investment in the round that you're investing in. It's a little bit of a fiction, and I say that with all sort of candor, in the sense that this valuation is not what you may think of with respect to like an accounting valuation. It's not the fair value of the company's assets. It's not the book value. It is really a way to determine share price and ownership. And so to get to what's called the pre-money or the pre-money valuation, you sort of back into it using this formula. It's the pre-money valuation, like I said, will determine the per share price. And to do that, you take the shares fully diluted of the company, which is the outstanding shares of the company before your investment, any shares that are outstanding with respect to derivative securities like option awards or warrants, anything reserved for the future option pool for that company, and shares reserved for anything else. And that is the fully diluted. And you take the valuation that you've sort of made up, let's say $7 million, and you divide it by the shares outstanding, which includes all of those things that I just said, and that's how you get to the share price for the financing. And I worded it this way because, again, like if your company is the investor, you care about the per share price and how much you're going to own, much more than you care about this quote unquote pre-money valuation. Post-money, when people say post-money, they're talking about the post-money valuation, which is the value of the company after your investment. But again, it's a little bit of a misnomer. To get to the post money, you take the number of shares outstanding after the financing, and it includes all of the things I talked about on the last slide. It includes shares that are reserved for options, shares for outstanding options, actually outstanding stock, warrants, all that stuff. And you multiply it by the price per share that you as the investor paid in the offering, in the financing, and that becomes the quote post money. I'm going to talk through a couple of sort of scenarios now so you can see how this is in practice. In this example, we have the company has 7 million shares outstanding. They have before the financing. They have another 500,000 options outstanding. They have another 500,000 option pool. So the fully diluted would be 8 million shares. However, this company is also going to add 1 million shares to its option pool in connection with the financing. And they also have outstanding notes that are going to convert that are being included in the pre-money. And then when somebody says included in the pre-money, they're talking about in that fully diluted number. So on this slide, the 8 million shares that was easy to figure out is in the first column on the left. But then you have to add the 1 million shares that will be added to the option pool and add 1 million shares that are issued to the notes that are outstanding. And then if you had a pre-money valuation of 10 million, the per share price that you as the investor paid would be $1. Now go over to the post financing, and in this financing, the company that we were investing in also issued warrants, 500,000 warrants. Those weren't in the pre-money, but they're in the post money. And so the post money, even though $1 million was invested on a 10 million pre, again, like that's sort of terminology for pre-money valuation, a 10 million pre and $1 million was invested because there were warrants issued, the post money is 11.5 million. And I'll make these slides available to the ACC so that you can sort of run this through on your own as well, because I know that it is confusing. This next example, it's very similar to the first example. We have a $10 million pre. We have the 8 million shares that was easy to come up with because it's the common stock, the options in the pool today. And we're adding in 1 million from the option pool that's going to get added. We're adding that to the pre. But we're not going to add anything for any notes or anything else that was converted. In that case, on a $10 million pre, we have 9 million shares on a fully diluted basis. And when you divide that into 10 million, the share price you pay now is $1.11 per share. And then you can see what happens in this case. The post money goes all the way up to 13.5 because we didn't count those notes, and we're still not counting the 500,000 warrants. And again, like I bring this up because it's sort of key to you as an investor to decide how much of the company that you want to own, assuming you're leading the round. How much of the company does your company need to own or want to own for its investment? And you back into that by using these concepts of pre-money valuation. If your company is not the lead investor, it's still important for you to understand what's been negotiated so that you can have a clear picture of how much you're going to own of the post-financing company. And these terms around valuation are important for that understanding. We're going to talk about other terms. So once again, if your company is the lead investor, you negotiate valuation pretty heavily, frequently. But there are other terms also that you're going to want to negotiate. So we just talked about valuation. When it comes to the terms of your investment, there's a potential that you invest it all at once. There's a potential that there are milestones. In other words, either time-based, like your company is going to invest half of its investment now, and then a year from now, you're going to invest the other half. And that is really so that you and the other investors can keep an eye on the company and or space out your investments for your own internal accounting reasons. Or it may be like event-based milestones, like the company needs to reach some sort of commercial point before you're willing to invest, or a research development objective before you're willing to invest all of the money. And this may be an area, Rebecca, where you have on the company side, some anecdotes or perspective about milestones and timing or anything like that?
Yeah. So, in my experience, whether we come in all at once or try and tranche the investment based on milestones, it's really depending on the size of our investment. If it's a small investment amount, we'll just come in all at once up front. But for a larger investment, I typically see our investments tranched and again, tied to typically event-based milestones. So you'll want to see the company hit a certain development objective with a product you're interested in, or a regulatory milestone, so that you are sure that they're going to have a path to commercialization for a product, something like that, before you come in, with your large investment. Another consideration is around use of proceeds. So typically for accounting treatment purposes, and we can talk about this more later in the presentation, you can't direct a certain use of proceeds. So you still, though, have in mind something you want the company to do with your investment amount, and you might want it to direct it towards a certain product or achievement, of a certain development objective. So what you'll do is say, we're going to invest a certain amount up front. Once you hit that objective, we might come in for additional amount. That's an indirect way to say they want the additional funding, so they're going to spend the resources to get to that development objective and have you come in for more.
Thank you. Some of the other things that, other key issues are the composition of the board of directors. So today we're talking in particular about investing in Series A. And so when you're investing in an early stage company, it's most likely still being run by its founders. But the Series A or the initial sort of institutional round of funding is when the board of directors starts to look different. If you were a venture fund investor, I would tell you that it's most likely that the venture fund, the lead investor or the group of investors are going to get a board seat. But similarly, if you're the strategic investor, this may be something that you're interested in. And I know Rebecca negotiates this all the time too.
Yeah, it's always a hot topic of whether or not we want to negotiate to have a board director seat or just observation rights, so where you participate in a board meeting in a non-voting observer capacity. And there's pros and cons, right? From a strategic perspective, if you're on the board, you have the ability to provide input, guidance to the company. You can kind of shift the company in a certain direction, but more importantly, you have access to information about the company. And a lot of times, when you're sitting around the table thinking about what company to invest in as the strategic, it's not about the financial return on investment. It's about having access to that company, the ability to stay close to the company, and again, negotiate some of those commercial or development rights. And so what you really want is to be able to stay close and get information about the company, and you'll get that by participating as a member on the board. However, it can get a little bit tricky when you have conflict of interest issues. So let's say your director is asked to vote or approve something that the company is doing that might be in conflict with what the strategic company actually wants, and navigating those conflict of interest issues and how you make sure that your director is complying with its fiduciary obligations to the portfolio company, and not having the conflict with what the strategic investor might actually want. So that's one thing. I also found that unless you have a really built out kind of venture group at your company, oftentimes the individuals who are participating on the board don't have a lot of time to actually devote to really engaging with the portfolio company. So they're asked to make important decisions as a member of the board, but they just might not be very engaged. And I think that puts you in a bad position too. So, on the flip side, you could say, let's just go for board observation rights. You have the ability to get all of the materials that they might distribute to the board, and also to participate in board meetings. So you're hearing the same things, you just don't get to vote on things that come before the board. I will say though, with the observation rights, you're always going to see the portfolio company saying, we're going to negotiate to carve out certain things from those observation rights so that they don't have to provide you with highly sensitive or competitive information. And they'll push that to, a limit where you're kind of being excluded from a lot of the meaningful information anyway. It's a lot harder to do that when you have a seat on the board. So in the end, what I've typically seen that we do is negotiate to have a seat on the board. if at any time we say there's, we don't want to nominate a person or actually have a board seat, the fallback is observation rights. You can always nominate to have someone fill that board seat in the future, but it can be vacant or filled by someone else in that, in any interim period. And then in that period, again, you get the information rights as a board observer.
And Rebecca, is it usually, in your experience or for your company, are you often actively looking for either board or observation rights, or do you find it more that the portfolio companies are asking to put that on you?
I would say it's both. I think they do like to have someone from your company on the board, someone with that industry experience who can kind of guide the company, especially, if you have more commercial experience, and you can provide that to some of the founders who might just be more focused on the technology and development. So it goes both ways. We often ask for it, and it's usually not a contested right. They'll typically give it to you.
Okay. Yeah, great. Thank you. I'm going to talk about liquidation preferences over the next couple of slides, and then future participation rights is also a really big negotiated point that we're going to talk about in a future slide as well. So we'll move on to liquidation preferences. So I want to talk about this, sort of in the same vein as when I was talking about valuation, because this is a universal feature of preferred stock. And if you're not necessarily in the business of investing in preferred stock all the time, this may not be intuitive. So preferred stock has a liquidation preference, and it's down round protection if the company that you're investing in is liquidated. And maybe that is a sale of a company, or it may be a true liquidation or dissolution of the company. The preferred stock has a preference on the distributions that are made to stockholders. It comes in a couple of flavors. The most common today, although the market shifts, but most common today is what's called non-participating. Generally, this means that the preferred stock has a right to get a preference, which is usually like get their money back. So if your investors invested $10 million in aggregate, the first $10 million of distribution, when distributions are made to stockholders in a sale or dissolution of the company, goes to that preferred stock. And 1x is the predominant multiple these days as well. If that stock is not participating, that means that the investors have to choose. They either get their $10 million first, and that's it, or they convert to common stock and they participate with all of the common stock. And so they lose their preference. And the reason why the $10 million preference is down round protection, basically, or down protection. In other words, if you were to sell the company for $10 million, or not very much more than $10 million, or less than $10 million, they get all the distributions. But if it's a win, if it's a good exit, and in aggregate, the preferred stock would do better than just $10 million when the company's liquidated, then they will choose to convert to common and give up their preference. Another common feature, although again, much less common these days than non-participating, is fully participating. In the fully participating scenario, the preferred stock get their, let's say, $10 million back first, and then they also get whatever the common stock gets. So they get a preference and they participate. And I have a slide that's going to show how this looks in a second. And so there's no reason for them to have to make a choice. There is a sort of hybrid of that, which is called capped participation, where they get their preference, the investors, you get your preference, and then you also participate with the common stock up until you get to some multiple, but not forever. It can be that the preference is more than just your money back. It might be 2 or 3 times your money back. That is rare and getting more rare. It's most frequently seen for a distressed company that is having a difficult time raising money, and the investors are requiring more than just their money back in the down scenario. So here's
Sorry, can I jump in? We have a question. Sandra asks, if the company you're investing in operates in a geography that is at high risk for corruption and or subject to sanctions, can observer rights be preferable to a board seat to insulate the investing organization from liability?
Yes. I think the short answer to that is yes. I mean, if you put a director on one of your portfolio companies' board, that director has fiduciary duties to that company, in addition to whatever duties they may have to your company. But they also have, liability for anything that company does. And so, being a director in either a sanctioned country or in another sort of risky sort of endeavor puts risk on that individual director that may or may not be worth the money. I don't know, Rebecca, if you ever run into this consideration.
Yeah, I haven't run into that particular issue, where we've been concerned about where the company is operating, but we definitely think about that. And the way I've seen it come up is we have a director on the board, and we've participated in investments in companies where they might not be doing so hot and they want to do a recapitalization, for example, or take other action that's going to impact its stockholders. And our director just says, I don't want a part of that. There might be liability on the director for taking certain action that impacts some of the stockholders in a certain way and some in another way. So we see that a lot with different things where our director is, concerned about potential liability for actions that the company is going to take. So for sure, we sometimes move to observer role in those instances too if we see a risk, and we always get indemnification agreements between the company and our director so that there is some kind of protection there.
That's a great point about indemnification agreements, because we don't have that in the slides, but that's a really excellent point. If you're going to put a director on a board, they should be indemnified by that company. All right, so liquidation preferences. So here's the setup. So you invested $3 million on a $7 million pre, and the post is $10 million. The option pool was in there, so the per share price that you paid was 71 cents. But the important thing here is that after your investment, you own 30% of the company. If you have a non-participating preferred stock, and the company is going to be sold for $20 million. You probably have a 1x preference, so you could take your $3 million back and you could be done. Or what you would do, which is what this is showing, is you would convert to common and you would give up a preference, and instead you would take $6 million, because it's basically a 2x exit, and so everybody gets 2x. You own 30% of the company. Along with the common stock, you're going to get paid and you're going to get $6 million out. If you had a participating preference, you would take your $3 million first. Then there would be, again, we're selling the company here for $20 million. You take your $3 million. There would be $17 million left. So then you would take your 30% of $17 million, and your proceeds from the sale of this portfolio company would be $8.1 million. You get a 2.7x return. Again, this sounds really lovely, but it's pretty unlikely or unusual, I guess, to have participating preferences. But this is what would happen if you did. We're going to talk about some other key points of negotiation. So one thing that when you're negotiating the terms for a preferred stock financing, one thing that you want to do, if you're the lead investor particularly, is negotiate for a no-shop provision. And maybe Rebecca would be more helpful from the investor's perspective on why and what this is.
Yeah, so when I think about a no-shop in the truest sense, when you're negotiating a term sheet, you might say, we're negotiating a no-shop. That means the company has to exclusively negotiate with you for the financing. They can't go take the terms you've negotiated and shop it around to other companies to say, do you want to participate on these terms? I will say from our perspective, you typically allow a company to to socialize the terms with other VCs or financial investors, but who we're really concerned about is other potential strategic partners. So, we're usually not the lead investor, at least in my experience at NuVasive, and so you'll have other financial investors who are going to participate in the financing round, and that's great. But you just don't want, say, a competitive company to come and also be participating in the round. You know, this is not necessarily a no shop in the way we think about it here, but I'll also point out that once we complete the financing as part of it, we also try to negotiate some rights that give us exclusivity in a similar way. Those are things like rights of first negotiation or rights of first refusal on a sale event of the company. So as a way to kind of protect our investment, make sure we might have acquisition rights in the future. We'll negotiate rights where if a company decides it wants to go out and solicit, you know, indications of interest from a sale event from third parties, they'll have to come to us first and allow us to participate in the negotiations for that. Similarly, if they were to get an inbound offer, let's say, you know, an offer to acquire the company, we might negotiate a right of first refusal so that we can participate on the exact same terms that they got from the third party. So those are kind of the two ways we tend to think about it.
Thanks for mentioning that second one. I was sitting here trying to remember why I put two ways on the slide. So so information rights are, so in preferred stock financing, the investors get information rights. At a very basic level, it's access to financial information. It's access to audited financials, quarterly financials, sometimes monthly financials of the portfolio company. Venture funds actually have additional rules. Most of them have like pension funds that are investors, and so they also have to have access to like anything they want, really. Like they have to be allowed to like inspect the company, talk to management, that sort of stuff. So in preferred stock financings, there's nearly universally information rights. But again, from a strategic perspective, there's an additional level that you're looking for, right, Rebecca?
Yeah. So obviously, those basic financial information rights, that's what our accounting team really needs to be able to manage the investment and think about, do they need to impair the investment? You know, how are they going to treat it from an accounting perspective? And then above and beyond that, you know, we want technology or company kind of focused information rights, so that periodic updates about how the company's doing, you know, any key milestones they've had from a regulatory perspective or commercial perspective. So that's another way to stay close to the company, especially important if you don't have a board seat or observer rights. That's really the way you're going to get updates about what the company's progress is.
And this is another area, right, where like the competitor like concerns often come in, right, where the portfolio company may try to keep information from you under some argument that you're a competitor.
Right. Yeah. And, you know, I've seen it play out where when you make the investment, you might not have a competitive, you know, product to the company or be a direct competitor of them on day one, but you might acquire a technology down the line or invest in another company that's a direct competitor of your portfolio company. And when that happens, you know, they definitely put on the brakes about providing you information, and you really have to pull teeth to even get some of that basic financial information that they don't want to share.
I'm going to continue clockwise because there's a lot to say about preemptive rights. So the next thing that is often negotiated, or per this slide that we're going to talk about, that's negotiated, is sort of the option pool and founder stock vesting. So when you're investing in an early company, they might not have an option pool yet. Like they may not even be thinking far enough ahead about having to incentivize future employees with equity. But as an investor, it's in your interest to make sure that the company is thinking about this. And the most obvious reason, or maybe it will be when you go back and look at the slides, the most obvious reason to me is because the option pool is put into the pre-money, So it doesn't dilute you if you get it done at the time of the financing. It's factored into your share price already. And so as a strategic investor, you will want to, if you're the lead investor or along with the other investors, make sure that the company is anticipating its hiring needs and puts that option pool into the pre-money. The other thing is founder stock vesting. So in early companies, very frequently, like I mentioned, it's still sort of the founders doing it. And maybe maybe the technology has progressed, so there's a team of other people as well. But I find that investors always tell me that they're investing primarily in the team. And so you want to make sure the team sticks around. And so you may consider subjecting the founders or other key players to vest. When you meet them, they may own their stock outright and they may own a significant amount of the company. But you can, investors can say to the founders or other key employees, like, look, we're going to make it so that your stocks reverse vests. So if you leave within a set time frame, you're going to have to give some of that stock back. And it's done as an incentive, just like your companies are giving options and RSUs as incentives for people to stick around. It's the same concept. And it doesn't have to be just because they own the stock outright when they meet you that they can't be subject to vesting. You can certainly, investors can certainly impose that. And anything on that, Rebecca, or move on to preemptive rights?
I guess I would just point out that that is not something that I see our business teams focused on a lot. So that's where it's really helpful as counsel or having outside counsel that's super experienced in all this stuff to be able to remind you of, the implications of where you factor in the option pool and the importance of stock vesting, because that's just not top of mind for them, but it really does matter, because you're so right. The team at the portfolio company is going to be what makes or breaks it in a lot of instances.
Yeah, awesome. All right, so preemptive rights. So nearly universal in preferred stock financings that the investors get what are called preemptive rights, or sometimes we call them rights of first refusal because the preemptive has some negative connotation. But either way, what it is a right for you as the investor to invest in future equity financings of the company. There's a bunch of exceptions to that, but generally it's intended so that if the company does a subsequent round, you as an investor can invest your pro rata in that financing. And most frequently, if all the investors don't want to, you can pick up each other's pro rata too. So it requires functionally, it requires the company to come back to you before it does a financing. Very frequently, these are waived on the venture fund side, but as a strategic, there's additional considerations on these.
Yeah, so we always negotiate for preemptive rights, and like Karen said, it's a universal right really attached to any series of preferred stock. From our perspective as a strategic and speaking on behalf of NuVasive, we always want the right to be able to maintain whatever percentage of ownership we have in the company. And that could be important because you might have, when we talk about it later, protective provisions that before the company can do something or take certain actions, they might have to get the vote of a certain percentage of, let's say, the Series A preferred stock. And if you control that vote, that gives you a lot of say over what the company can and can't do. So from that perspective, it's important to be able to maintain that ownership percentage. But on the flip side, I think what we most often see is there becomes a lot of pressure or an expectation from the portfolio company that because you have a preemptive right, you'll exercise it. And they obviously want you to continue to support the company and participate in those future financing rounds. And it doesn't always turn out that you want to. And so, I think what happens is when you're viewed as the strategic partner of the company and you don't exercise the preemptive rights, it has a chilling effect on a lot of the other investors who are like, well, if they're not getting the strategic support, why would we re-up on the investment? And so that's, something tricky, I think, or I've experienced that we have to navigate, where yes, it's a right, but also it can become an expectation from the company.
And some additional preferred stock features that we're going to talk about relatively quickly, just so that you sort of know what they are. Protective provisions is the terminology that's used for special shareholder voting rights, where the preferred stock as a group have to approve any number of things that the company may want to do. There are some very basic things like amending the rights of your stock, or changing the charter, or taking on a bunch of debt. But there's probably I usually see between 6 and 16 of these included, and it can be everything. It can also be like changing the size of the board. It can be a number of things. And essentially this just means that you have to go to the stockholders in order to get their approval. So protected provisions is a little bit of a misnomer, but that's essentially what it is. Redemption rights are uncommon. They are marginally more common in technology deals than they are in biotech, but redemption rights essentially say after a period of time, you as an investor can put your shares back to the company. They have to buy you out, probably for what you paid for it. maybe with interest in the form of accruing dividends, but pretty uncommon, very uncommon to actually be able to exercise them. There are a bunch of restrictions under California and Delaware law that don't let companies redeem their stock. And so this is not common and even less common used. Drag along rights are the right of the investors to, and sometimes the investors and the board, to approve a sale of the company and drag along other stockholders. As an investor, if you're not the majority investor, you may be just dragged yourself. And I'll be interested to hear in a second what Rebecca thinks from a strategic perspective, but that has some complications if the strategic is also potentially the acquirer down the road. Registration rights are the rights of the investors to get your stock registered with the SEC so that you can get liquidity that way. Usually it's like 5 years after your investment, or 3 to 5 years after your investment, you can push for this. It's almost a universal feature of preferred stock, but very rarely used also. Dividend rights are most typically a preference. So before the company can pay any dividends to its common stockholders, they have to give 6 or 8% of the investment amount in dividends as a preference to the preferred stock. Probably the companies that you're investing in, we're talking about Series A, so these companies are probably not paying dividends anyway. This is a way to protect yourself from the company sort of leaking money out from underneath you. And co-sell rights are essentially if the founders or other key large stockholders want to sell their stock in the company, you get a right to buy it from them first. And if you don't buy it from them first, you get a right to co-sell. It's the idea of like, if the founder's getting off the ship, we're all getting off the ship. And it's just a way to keep incentives aligned. I don't know, Rebecca, if you had any strategic perspectives on these.
Yeah, so I would say for the most part, a lot of these rights are not heavily negotiated by a strategic partner. I think protective provisions and the drag along rights, so we do have more of a say on those. The others are pretty standard across the board, and especially if there is a lead investor, we kind of follow along with what they go with on these. But touching on the protective provisions briefly, Karen mentioned that there's a whole number of items that might be included as requiring a consent of a group of the stockholders. And one thing to consider is, if it's not already put in there, you could use that as an opportunity to protect perhaps some of the commercial rights that you negotiated as part of the deal. So you might require consent to do things like grant a license to intellectual property rights of the company, or other things that could potentially undermine your commercial or development relationship with the strategic company. So that's, one thing that we think about. Then as it, relates to the drag along, I typically see some of our portfolio companies wanting to require this so that if, let's say, a competitor comes in and acquires the portfolio company, we can't drag our feet to say, it's not good for us that they do this, so let's, be a pain in their side to actually getting the deal done. We'll typically agree to it, and that would only come into play again if you've negotiated certain acquisition rights. They have to go through all of those hurdles first, and it's only then, if you pass on those, that you're going to be subject to the drag. So, just something to consider there. I will say, being on the acquiring side, when you're going to acquire a company, whether it's not one that you've invested in or not, it's not ideal to have to rely on the drag in order to get a deal done. You want all the stockholders to approve it to begin with. You don't want any dissenters. It just complicates things. So not ideal if you have to rely on the drag, but typically we'll agree to it if it's important to the company.
Thank you. And that's a great lead into some of the special, what I consider like the special features of strategic investment. And Rebecca, you've mentioned a couple times in this the concept of a linked commercial arrangement. Like, what are some examples of things that you guys have pursued?
Yeah. So in my experience at NuVasive, at least, in almost every investment that we've made, it's always been paired with or kind of contingent upon a commercial arrangement with a portfolio company. And that could be a development collaboration. It could be commercial collaboration. It could be a co-marketing agreement. So, typically when we're thinking about what companies we want to partner with, the conversation starts with, what technology or product are we really interested in? And only then do you think about why would we want to structure this as an equity investment with a commercial relationship versus a straight commercial relationship, a full acquisition, a licensing deal. So there's, various things around what funding the company might need, the accounting considerations, all of those things that kind of go into how you structure it. But again, in my experience, at least at NuVasive, we don't do a lot of, straight financial investments. It's typically attached to a commercial agreement of some kind.
And we've talked about the future participation rights, I think, pretty much already. So, but you did just mention accounting considerations. So, sort of to the third bullet on here, what are some of the things that you guys think about when you invest that like a professional investment fund doesn't have to think about financial-wise?
Yeah. So it's always top of mind for strategic, I think, to think about the accounting implications of an investment. So you have to work really closely with your accounting and finance teams to make sure you understand what the implications are and that you're getting the desired accounting treatment for your deal. So I won't go into too much detail, but there's kind of two accounting treatments that we think through. And there's others, obviously, depending on the size of your investment. But typically, for a minority investment, it'd be treated as cost method accounting or equity method. In a cost method accounting, you have no automatic impact to your P&L. So with an equity method investment, you have to absorb a percentage of the target company's losses. So there is some more consolidation of your financials. So the accounting treatment really depends on a number of factors. The biggest one is the percentage of ownership you have in the company. I think from a straight numbers perspective, the threshold is 20%. So if you own more than 20% of a portfolio company, you switch over to equity method accounting. A number of other factors, though, kind of weigh in on this, and it really depends on how much control you have over the business operations of the portfolio company. That can depend on everything from the exclusivity obligations that you negotiate as part of the commercial arrangement. The acquisition rights are obviously a big thing. If you have a board seat, that impacts the overall control you have on the company. And as I mentioned before earlier in the deck, control over use of proceeds. So if you're specifying you have to do these activities with the amount of funding that we're giving you, that trips up accounting treatment a lot as well. So it's kind of some of those are more subjective factors. Obviously, the ownership percentage is fixed, but you really have to think about those in totality and analyze that with your accounting group to make sure you're not running afoul of whatever treatment you're trying to get at.
Great point, which I would not have had anything smart to say, so thank you. So what sort of like limits do portfolio companies try to get on your business?
Yeah, it's interesting. So obviously, we've talked about all the ways that we negotiate rights and preferences to try and tie up a portfolio company. Similarly, they have an interest in not having you partner with competitive companies or doing things internally that might be competitive to the company. But we typically have the leverage in a lot of those negotiations, and I haven't seen an instance where we've at least been willing to at all limit our ability to partner with, invest in, acquire competitive technologies. You really don't want this to limit any of the potential activities of your company. Obviously in some of the commercial arrangements, you would agree to, I wouldn't say necessarily exclusivity, maybe some limited exclusivity. If it's a commercial agreement, you might agree to certain commercial minimums in order to continue the relationship, just so you're not stifling the company, things like that. But if they ask for it, I don't think many strategics would be willing to limit their operations at all. But I guess, one point to think through there, and something that's come up in my experience a lot, is the more you tie up a portfolio company through all of those rights, through acquisition rights, through the commercial obligations, you you really, you might prevent the company from finding alternative sources of financing. And that's where things like expectation to participate in future rounds comes in. Because, you know, as much as it's good to have all of those rights, another strategic's not going to come in and invest. And you probably won't get the financial investors coming in either unless the current strategic partner re-ups and continues to support the company. So that's, you know, something to think about. Are those rights really meaningful? What are you doing to the ability for the company to succeed? And kind of evaluating that as the relationship goes along.
That's a great point also. So I think we talked about the competitive point pretty well as well. I think the point that I see mostly is sort of what I mentioned about potential competitors being restricted in the information that the portfolio company has to provide. And then the sort of sticky things that you talked about earlier with respect to the board and observers. I don't know if there's anything, I think maybe that's what we were going to talk about on that point.
Yeah, I think that's you know, where I see them trying to limit our otherwise standard rights as a stockholder with the information stuff. Yep.
And we just wanted to make a quick note about convertible notes and safes. We're not going to spend a bunch of time on this, but these are pretty popular fundraising avenues for young companies. And so we've talked a lot about what to negotiate in a Series A financing, which would also be a seed financing. But if you're going to negotiate for convertible notes or safes, these are sort of the key negotiation points. Interest rate, and I've put on here sort of what's market, 4 to 8% annual, simple interest. Maturity date, usually it's 12 to 24 months. And there's a bunch of legal reasons why it doesn't go usually longer than that. The conversion discount. So both of these convertible notes and safes are essentially instruments that convert into the company's first preferred stock financing, or what is frequently called a priced round. And so most often these instruments convert at a discount. They might also have warrants associated with them, which would be another way of sort of getting a discount. And oftentimes they have a valuation cap on the conversion, meaning that when they ultimately convert, there's a maximum pre-money valuation that they would convert at. And again, I didn't want to leave this audience pretending like those things don't exist. Now we're going to talk about some practice tips. And I think, is there anything else that you want to say about conflicts of interest, Rebecca?
You know, I don't know if anything specifically, but I guess just to highlight again, that becomes a big sticking point typically as the relationship goes on. So when you're making your initial investment, especially if it's in a Series A round, you know, you're really excited to partner with other company. You tie yourself together with this company, but the reason you're making an investment and not acquiring it is perhaps you couldn't reach terms on valuation, but maybe you just want to prove out the technology and you don't know if, you know, the company's roadmap fits with your own, or if it's going to, you know, fit into your product portfolio. So it's really a way to just have an option and stay close to a company that you're interested in. But when it goes sideways, or even short of going sideways, you might acquire competitive technology again, or you might start something internally that becomes directly competitive. It becomes, you know, potential for conflict of interest, especially if you have a seat on the board, becomes a bigger issue. So I think it's just important to point out, you have to continue to kind of manage and evaluate the investment as you go forward. If you start to engage in super competitive activities, you might want to think about, should we, you know, resign from the board and have observer seats and even fight to get those, just because of the potential conflict of interest issues there. You know, you can do as much as you try to say, let's put someone who's not involved in the business as a strategic on the board of the portfolio company, but there is just always the fear that you're going to be sharing information internally, and how do you really segment that off? Is it even possible? I think is a consideration that you have to work through and really protect your director on the board from.
And what about when you're sort of over it, right? If your company is like, this technology is not what you thought it was, or not working out, either because you're doing it some other way or for any reason, I guess, like any tips about how to shift from being a commercial partner and stockholder to really just what ultimately is a stockholder, or anything that is asked of you that you can share about?
Yeah, I think that goes both ways, right? So it could be that time has gone on, you're no longer interested in the technology, or you don't necessarily see a feature of that technology fitting with your strategic objectives. So it could be the strategic that says, hey, I want to part ways, I want to step back, I want to give up some of my commercial rights and obligations that we might have. And so you'll initiate those discussions, but oftentimes it's the portfolio company that says, we see these activities that you're doing with third parties or starting to do internally. We're conflicting with you in the marketplace. And they'll come to you and say, we're completely stifled. We can't get additional funding because you're not supporting in the sense of maintaining your investment. And we want to be able to really take this and run with it with someone else. So they could approach you and say, can you step back on some of these rights? And typically, if you reach that point, regardless of who's initiating the discussions, you might not actually want all of those rights or obligations. And oftentimes we'll negotiate to either scale back or terminate some of the commercial collaboration agreements that we have or development collaborations. You'll also ease up on some of those aggressive rights that you might have negotiated, like the acquisition rights. We'll typically maintain the preemptive rights. We'll maintain all of the other rights that we have as a stockholder, but it really transitions it more just to a role of a passive financial investor. And that's probably good for the strategic company, because if they're allowed to go partner with someone else, get alternative sources of financing, run their business with fewer restrictions, you could have a great return on your investment. And all you have to do then is manage it from a financial perspective, where you get some requests in your role as a stockholder to approve things, and take any actions that might come up as a stockholder. So I've seen that in a number of instances, and it's not always a bad thing, but definitely something that you have to manage, and that there might be differing viewpoints from your corp dev team versus your business team on how they want to handle things. But not always a bad thing, just something that you have to kind of navigate over time.
Yeah, I mean, I can imagine you step back commercially maybe, but you keep the upside in the investment. If they're able to be successful without you, then that's a win-win.
Right. Yep.
Well, we are just about out of time, and I'd like to leave just a couple minutes in case there are any questions. But we've almost used our time. Let's see some of the questions in the chat. What is the term for a situation where the co-founder's percentage ownership in the company is protected, and can this be unwound? So this would be like an anti-dilution provision that some founders or even executives might have in their employment agreements, that might say maybe for this company to hire the CEO that they wanted, they had a promise that they had to give the CEO 5% of the company, and then they had a promise that the CEO can keep 5% of the company until a certain point, until a certain amount of money is raised, or God forbid, forever. So you do see that sometimes, and it's usually called an anti-dilution provision. It certainly can be unwound. I mean, if the company is coming to your company for investment and that doesn't work for you because the numbers don't work or because it doesn't make sense to you, those are certainly the type of things that get renegotiated in connection with financings. Just like you could impose vesting on an executive or a founder as part of a condition to investment, you also could unwind anti-dilution provisions. There's a question about whether each party pays its own legal fees, or does the target pay both parties' legal fees? Real quick, Rebecca can tell me from her experience, but most often the portfolio company is going to pay VC legal fees. And so then I don't know, how is it usually for you guys? You get your fees paid?
Typically, if we are the lead investor, we will ask for reimbursement of legal fees, and you typically get it. you know, if we're not, sometimes we'll get a smaller chunk of our legal fees paid, but it's really the lead investors counsel who's doing a majority of the work on the documents anyway. So we'll usually cover our own costs in that instance.
And then there's a question about, it says, with companies exiting private market later and a trend towards less capital intensive startups, what shifts have we seen in what are considered market terms? You know, most of the stuff that we've talked about on this presentation is really standard. I have, you know, been practicing for 15 years, and I've seen the market shift with respect to liquidation preferences and dividend preferences and interest rates on convertible debt. But the core of what a preferred stock financing is doesn't really change. It mostly varies with respect to the stage of the company and the financeability of the company. If you're investing in a portfolio company that has other options, you know, the company's going to be able to negotiate for itself better terms, just like in any business transaction. If the company really needs or thinks that it needs you as a strategic partner, you are likely to be able to negotiate for yourself better terms on the edges still of what's market. It's really, there's not that much variability when it comes to preferred stock terms or the features of preferred stock. It's going to be in the commercial arrangement that you're able to negotiate, and it's going to be in the valuation, which was the first thing we talked about on the presentation, like with respect to how much you're going to own of the company. That's really where most of the negotiation happens, unless, Rebecca, you have a different experience.
No, I think that's right, Karen.
Well, that's it. We're right at an hour, and I think we answered all of the questions. So I'd like to thank everybody again for this opportunity. My information is still up on the screen, and so you feel free to reach out to me anytime